Welcome to the deep dive. Today we're digging into the Coca-Cola Company, ticker KO. We're looking at their Q3 and year-to-date financials for 2025.
That's right. And our mission really is to unpack the margin story here. With a giant like Coke, understanding how they actually make profit, especially with all these macro challenges, is key.
Exactly. And we want to highlight the difference between those reported GAAP results and the comparable non-GAAP figures.
Because the comparable numbers often tell a clearer story about the core business performance.
Okay, so let's jump into the headlines for Q3 2025. Net revenues looked, well, pretty solid. They grew 5% to $12.5 billion.
Right, but interestingly, that non-GAAP measure, organic revenues, it actually grew a bit faster at 6%.
Okay, 6% organic. But here's the thing that jumps out. The global unit case volume growth.
Yeah.
It was pretty slow, just 1%.
Only 1%. Yeah, that's the first clue, isn't it?
Yeah.
We need to follow that thread. Now look at the earnings per share, the EPS.
Okay.
Reporting EPS jumped a massive 30% to 30% to 86 cents.
Wow, 30%. That sounds incredible.
It sounds incredible, yeah. But then you look at the comparable EPS, the non-GAAP number, and that grew a much more, let's say, moderate 6%. Still healthy, up to $1.92, but nowhere near 30%.
Okay, that's a huge difference. 30% reported versus 6% comparable. What causes such a massive gap?
Well, it nearly always comes down to cleaning house in the prior year. When you see a reported spike like that, it usually means the previous year had some really big one-off charges.
Making this year look better by comparison.
Exactly. We'll get into those specific charges later, things related to assets, liabilities, restructuring. But for you listening, the key takeaway is that the comparable numbers matter most.
Because they strip out things like currency swings and those big one-off items.
Precisely. They give you a much better view of the actual underlying performance of the business itself.
Okay, got it. So let's dig into that 6% organic revenue growth then. If volume was only 1%, where did the other 5% come from?
Right. Well, the mechanism here is pretty clear. That 6% organic growth was almost entirely driven by 6% growth in price mix.
Price mix. So basically higher prices and selling more premium stuff.
That's it in a nutshell. And interestingly, concentrate sales were actually flat. 0%. They lagged slightly behind that 1% unit volume growth, probably just due to timing of shipments.
So they're really leaning on pricing power here.
Heavily. It's a fascinating trade-off, isn't it? They're using that pricing leverage to hit the revenue targets even with sluggish volume.
Which raises the question, how long can you keep hiking prices or improving mix by 6% when your volume is only ticking up by 1%?
That's the million-dollar question, or maybe $1 billion in Coke's case.
Correct.
It's definitely something to watch.
It's a classic balancing act. Okay, so looking closer at that 1% overall volume growth, which parts of the business actually were growing?
Well, the more diversified segments really pulled their weight. Water, sports drinks, coffee, and tea together, they grew a pretty solid 3%.
Okay, 3% there.
Yeah, sports drinks were up 3%, mostly led by North America, and water also grew 3% pretty much everywhere. So that really shows the value of having that broad portfolio.
Definitely. And what about the core business, the sparkling soft drinks? Was holding flat considered a win given the price hikes?
You could argue that, yeah, sparkling was even overall. I mean, holding volume flat while pushing through significant price increases, maybe that is a success in this environment, but it's certainly not growth acceleration.
Right.
But within that flat number, there were some bright spots. Trademark Coca-Cola itself still managed 1% growth.
Okay.
And the real star, again, was Coca-Cola Zero Sugar. Impressive 14% growth across all regions.
Wow, 14% for zero sugar. That consumer shift is really powerful.
It really is. It's paying off significantly for them.
Were there any weak spots in the portfolio, volume-wise?
Unfortunately, yes. Juice, value-added dairy, and the plant-based drinks, they actually declined 3% collectively.
Okay. Any specific reason for that?
It seems like that weakness was mostly concentrated in the Asia-Pacific region. Declines there basically wiped out the growth they saw in Latin America for those categories.
Got it. And that brings us to the regional picture. You mentioned Asia-Pacific declined 1% overall. How did the others fare?
It was quite varied. EMEA, that's Europe, Middle East, and Africa, was actually the strongest region for volume, delivering 4% growth.
Okay, so EMEA was strong.
Yeah. But then you had Asia-Pacific down 1%, as we said, and Latin America and North America are both basically flat. 0% volume growth in both.
So that pricing power strategy clearly isn't having the same volume impact everywhere.
Exactly. It probably works best in markets where consumers can absorb those price increases more easily. So now let's see how all this pricing action flowed through to the bottom line. Let's talk margins.
Right, profitability. So Q3 2025, The reported GAAP gross margin came in at 61.5%. That was up from 60.7% last year, so an 84 basis point improvement.
Right, and just quickly for anyone listening, a basis point or BPS is just 1/100th of a percent. So 84 BP is a bit less than a full percentage point improvement in gross margin.
Good clarification. So almost a point better on GAAP. What about the underlying margin?
The underlying gross margin, the non-GAAP one, that expanded by approximately 80 basis points in Q3. So pretty close to the reported number in this case.
Okay, and what drove that 80 BP's underlying improvement?
Well, it was mainly two things. First, that strong organic revenue growth we talked about coming from the price mix.
Right.
And second, some pretty effective cost management. They really needed that because they were still fighting higher commodity costs. So it looks like they navigated that inflation pretty well through both pricing and efficiency.
And I remember you mentioned structural changes earlier. Did that play a role here too?
It did, yeah. There was a structural tailwind, basically a helping hand, of about 50 basis points in Q3 for the gross margin.
Okay, and what caused that?
That came from their ongoing strategy of refranchising bottling operations, specifically selling off some bottling territories in India during the quarter.
Ah, so selling lower margin bottling businesses boosts the overall company average margin, at least statistically.
Exactly. It's a structural effect. And if you look year to date, the underlying gross margin expansion was actually even better, around 100 basis points.
A full percentage point improvement year to date.
Yeah, showing good consistency. And the year-to-date structural help included not just India, but also similar refranchising efforts in the Philippines.
Okay, now for the really eye-popping number from the report. The operating margin. The reported operating margin just skyrocketed to 32.0% in Q3. Last year, it was 21.2%.
Yeah.
That's a jump of 1,080 basis points, over 10 percentage points. How is that even possible for a company this size?
Well, like we hinted at earlier, it's really only possible when you understand the non-GAAP reconciliation. That kind of four-figure basis point jump is a massive red flag saying the prior year had some huge unusual items.
Okay, so what was the real underlying improvement?
The true comparable operating margin, the non-GAAP figure, was 31.9%. Last year, it was 30.7%. So that's still a very strong increase of 115 basis points. Healthy growth, but nowhere near that 1,080 number.
Okay, 115 BPs makes much more sense. So what were those huge, noisy items in the prior year that caused the gap difference?
Right. This is really important context. That massive reported gap increase was mostly because last year, in Q3 2024, they recorded huge charges related to remeasuring the Fairlife contingent consideration liability.
Contingent consideration. That sounds like something related to the acquisition.
Exactly. Think of it like a big accounting adjustment tied to hitting certain milestones after they bought Fairlife. It required a massive charge last year. Plus, they also had other things like asset impairments, some restructuring costs, hedging activities.
So basically, last year's Q3 gap numbers were hit hard by a lot of non-operational cleanup type costs.
Precisely. They were kind of clearing the decks of bad news, which made last year look artificially bad on a reported basis, and therefore made this year look artificially brilliant by comparison.
Okay, that absolutely explains the 1,080 jump. So setting aside all that noise, what drove the actual core operating margin improvement, that 115 BP's comparable increase, or even better on an underlying basis?
Right. The underlying operating margin actually expanded by about 260 basis points in Q3, and year to date, it's around 270 BPs.
Wow, 260 BP's underlying. That's really strong. What drove that?
That came from, again, the organic revenue growth flowing through, and also, crucially, very tight, very effective cost management across the board.
But looking at the numbers, it seems like management made a choice that actually held that margin back a bit. Is that right?
That's a sharp observation. They did. That excellent underlying margin expansion was partially offset because they made a deliberate choice to significantly increase their marketing investments.
Ah, so they took some of the gains from efficiency and pricing and plowed it back into building the brands.
Exactly. It's a classic strategic trade-off. Investing for future growth, even if it slightly dampens the immediate margin number. Probably a smart move long-term.
Makes sense. And speaking of brands, maybe we can shift gears a bit from the dense financials to the strategy itself. The franchise model is key, obviously, but where are specific brands really showing that these strategic bets are working?
Yeah, good idea. We're seeing some really strong performance in those high-value specialized segments. Take value-added dairy, for instance. We know Fairlife is doing well in the U.S.
Right.
But look at Mexico. Their Santa Clara brand actually became the value share leader there, and it grew volume by 13% just in this quarter.
13% volume for Santa Clara in Mexico. That's impressive. And what about the sports drink category? That's always super competitive.
It is. But their strategy there, using both Powerade and Body Armor, seems to be working. They actually gained value share and grew volume during the quarter. So that suggests their dual brand approach is capturing different consumer needs effectively.
Okay. And any highlights from the tea portfolio?
Definitely. Fused Tea is performing really well globally. Its retail value grew 5 times faster than the overall tea industry average so far this year. It's holding on to its leadership spot.
5 times the industry average. Wow.
Yeah. And that focus on low sugar or zero sugar isn't just for Coke Zero. They're expanding Minute Maid Zero Sugar into some Asia-Pacific markets now.
And how's that going?
Early signs are good. Strong consumer interest, good volume performance. It fits that global health and wellness trend.
Okay. We touched on refranchising earlier as a structural tailwind for margins. Is that process still ongoing? Are they making more moves there?
Yes, absolutely. The focus is still very much on streamlining the system, getting bottling into the hands of strong, capable partners for the long haul.
Any recent examples?
Well, they announced a big one. A definitive agreement for Coca-Cola HBC, that's CCHBC, one of their big European bottlers, to acquire a controlling stake in Coca-Cola Beverages Africa, CCBA.
Okay, consolidating in Africa.
Right. And another major step happened in India. They finalized the sale of a 40% stake in their main Indian bottling holding company, Hindustan Coca-Cola Holdings, to a local partner, the Jubilant Bhartia Group.
So big strategic shifts continuing there. And those kinds of structural changes obviously impact cash flow, which is our next stop. Looking year to date, the cash flow numbers seem low at first glance.
They do seem low initially, yeah. Year-to-date cash from operations was $3.7 billion. And free cash flow, the non-GAAP number, was only $2.4 billion.
Only $2.4 billion free cash flow for 9 months for Coke? That seems off.
It seems off until you remember that one massive item we discussed earlier, the Fairlife payment.
Ah, right. That $6.1 billion final one-time Fairlife contingent consideration payment, that happened in the first quarter, didn't it?
Exactly. That was a huge cash outflow. So if you back that single payment out, the year-to-date free cash flow was actually a very healthy $8.5 billion.
Okay, $8.5 billion excluding that one item. That makes a lot more sense. Understanding that outflow is critical.
Absolutely crucial for seeing the real operational cash generation strength.
So with that context, let's look ahead. What's the company saying about the full year 2025 outlook? Are they sticking to their guns?
Yes, they seem pretty confident. The guidance for organic revenue growth remains unchanged, still expecting 5% to 6% for the full year.
Okay, holding steady there. What about earnings?
Comparable EPS growth is also expected to be around 3%. Now, that 3% number is really interesting because it includes an estimated 5% headwind just from currency translation.
Wow. So they have to generate 8% growth operationally just to end up with 3% reported comparable EPS growth because the strong dollar hurts them that much.
That's exactly right. It really highlights the significant pressure they're under from those macro factors, especially the strong U.S. dollar, impacting overseas earnings when translated back.
That's a tough environment. Any update on the cash flow target for the full year?
Yes, and it's actually good news. They've updated the free cash flow target, again, excluding that big Fairlife payment. They now expect it to be at least $9.8 billion.
Okay, up from $9.5 billion before.
Right, so that signals confidence in their operational efficiency, working capital management, hitting those cash goals despite the pressures. And just one final guidance point. The underlying effective tax rate, non-GAAP, is estimated at 20.7%.
Okay, so pulling this all together then, what's the core message from Q3?
Well, I think Q3 really showed that Coke's core strategy is pretty resilient right now. They successfully used their pricing power. That 6% price mix growth was key and combined it with some aggressive cost management.
Which allowed them to expand those underlying margins, right?
Yeah.
80 basis points on gross, maybe 260 on operating.
Exactly. And they did that while meeting their overall guidance, even though they were fighting significant commodity inflation and that huge 5% currency headwind on their earnings.
So the focus seems to be shifting away from those big historical cleanup charges like the Fairlife stuff.
Right, moving away from that noise and really focusing on core sustainable cash generation and reinvesting back into the brands through marketing.
Okay, so let me leave you, the listener, with this final thought then. We saw that the company is relying really heavily on pricing actions right now to drive that organic revenue 6% price mix versus just 1% volume.
Yeah, that's the core tension.
So the big question is, How much longer can that kind of aggressive pricing and cost cutting keep delivering this really strong margin expansion before volume has to pick up the pace to maintain the momentum?
It's absolutely the dynamic everyone should be watching going forward.
Hmm.
But there is maybe one little glimmer of hope on the horizon for them. Management actually mentioned they're expecting a slight currency tailwind for Q4 and potentially for the full year 2026.
Interesting. So the dollar might weaken a bit and actually help them for a change.
It could. If that materializes, it would certainly ease some of that pressure and give a nice little boost to the reported results next year. Something to keep an eye on.
Definitely. A really fascinating look under the hood of a global giant navigating some complex times. Thanks for walking us through those numbers.
My pleasure. Always interesting to dive into KO.
That was the deep dive. We'll catch you on the next one.